Hi, happy Monday, happy tax day. Not really. Credit cards have gone up substantially. They were around 14%, and that was just 4 years ago. Now they're around 24%. They may go higher, they may continue to go up, and it's not just credit cards. I'm going to talk about who is doing this, why should you even care, and what can you do about it? How is it affecting you, and what can you do to guard yourself against it? I always like to say, government doesn't care about you, banks don't care about you. Getting out of debt is freedom. It's your financial freedom. You got to take control of it. Take a quick look at what I provide on my show playlists, and then we'll get into it.
So take a look at the playlist page for Hack Your Finances. You can obviously subscribe at the top. Playlists to get out of debt, credit cards to use to your advantage, and investing for passive income. At the bottom, we've got a 6-lesson series to help you get out of debt. Thanks for watching and supporting the channel.
Now, who is doing this? Well, essentially it's the government and the Fed funds rate, the Federal Reserve. The Federal Reserve sets the Fed funds rate. They are supposed to do two things, or keep their eye on two things and try to achieve two things. They're trying to keep people employed, so keep the unemployment rate down. More people have jobs. And then also keep inflation down. They've set a target of 2%. They've said repeatedly that they're not going to cut rates again until they get inflation down. So let's take a look at that Fed funds rate and what does it mean. If you look here on the chart, this is the Fed funds rate. And right now it's sitting at around 5.33%. Okay, so they like to say it's between 5.25 and 5.5. Now this is the rate that the Fed is setting. This impacts what the banks do, overnight lending rate and other things. So when the Fed funds rate goes up, interest rates go up. When it goes down, interest rates go down. Now let's take a quick look at these three articles. We've got here Jamie Dimon. Why do you listen to Jamie Dimon? Well, because he runs JP Morgan Chase, which is the largest U.S. bank in the United States. He's saying that it's possible that that rate I just showed you could go up to 8%. Now that may mean we see mortgage rates of around 10% and things like that. Then of course you've got other magazines. Fortune says, well, maybe there's not going to be any rate cuts at all this year. Reuters said, well, there probably will be rate cuts. But regardless of what the media is telling you, he has basically said, the Fed Chairman Powell, that until inflation comes down, and we know inflation's running at around 3% or high 2s or low 3s, that he's going to keep these rates high. Okay, so when Jamie Dimon says 8% looking at this chart is possible, people might say, no, it's not possible, it's never happened. Okay, no, let's look. Right here we got 1955 going all the way forward to today. And this is the 7.5 line up here. So back in, let's just go back in time. In the 70s, we had 8% and over. Right, it's 8.8. Here's in the 70s. It was up as high as, good grief, 12.92. That was the 70s. What about the 80s? Well, here's our 7.5 line. Looks like almost throughout the 80s it was 7.5 or higher, and it peaked at 19%. So the 70s, over 8%. The 80s, over 8%. The 90s, well, here's 9.81. Let's see, 1990, 8.26. Okay, so we had over 8% in the 70s, in the 80s, in the 90s. So is it possible? And then they came down. They've been staying under 7.5% for at least through the 2000s. You can see here it was down around 0. But look at the typical Fed funds rate in this area throughout time. It has only been in the 2000s that we actually had this 0%, which meant that you were getting mortgages at 2.5%, and you were getting car loans at 4 and 5% and stuff like that, right? And then we had it for a little more. That was like 5 or 6 years. We had a couple, 2 or 3 years here, and it's back up to around 5. So people talk about getting back to 0. 0 was, look at the past, is not the norm. So stop thinking that rates are just going to plummet. Maybe they come back down. Maybe they don't. Maybe they don't for a long time. Okay, so now we know what's going on. This Fed funds rate is up because we have inflation, which we all know. We've had it for a while. Who did that? Why did they do it? And what does that mean? So what does it mean? Well, let's take a look at these rates. We're going to go over the rates for credit cards. Now, something I want you to look here. I like to use this as Lending Tree. Links will be below for all these various sites. Previous month, 24.61. The average, 24.66. That's the average percentage rate on credit cards. Now, this is what I want you to note. Previous month, 6.1, now 6.66. You're thinking, that is not a big difference. What's the big deal? Who cares? Well, because they always like to make things incremental so you don't notice them. What do I mean? Well, if we look back here at Credit Where Credit Is Due, NerdWallet. All right, this was in, they updated this 2023, but that doesn't matter because here is the data. Average credit card interest rates from 2017 to 2021. Look at the average rate. It was 12.89, 14, 15, 14, 14. Okay, so for this 5-year period of time, it was basically 13 to 14, as high as 15%. But what was it, or I should say, what is it now? 24. That's almost a double. It's not a double. 14 to 24 is a 10% increase. That's substantial. That is up huge. Month to month, it may not look like much, but it wasn't that long ago that you were only paying 14. And if you use a calculator, the difference between something like 14 and 24 is substantial. Okay, so credit cards are still high. And they were not that high, and it wasn't that long ago. Personal loans. This is going over, this is Business Insider. I like using this one. Talked about last week's rates on average about 21%. This week's 21%. Why would you have a personal loan? Well, some personal loans you can get without any collateral. What does that mean? Well, if you get a car loan, the collateral is your car. You don't pay the loan, they come take your car. You can get a personal loan where there is no collateral. All they can do is just bug you to make sure you pay. Now, of course, you should pay your bills, but they can't come and take anything. Now, some personal loans have collateral, but some do not. So the average is 20%. You're thinking that's incredibly high. Well, if you have good credit, as you see here, you can get as low as 11%. There's one around 6%, that's American Express, but you can see that it can be higher, it can be lower. But if you're able to get 11% for, let's say, $20,000, and you pay off 2 credit cards, each with a balance of $10,000, and they were at 24%, and you're able to get that down to 12%, that's substantial. And also know that with credit cards, that shows up on your credit report as revolving credit, which is different than a personal loan, which is installment credit. Because with a personal loan, if you take out, let's say, $10,000, it's going to be for a set amount of time, like 60 months at $500, whatever it is. So that's going to show up as an installment loan, which will be different. So credit card consolidation using personal loans is not a bad idea if you can do it. If you can use the 0% balance transfer, great. We'll talk about that at the end. Let's look at average. This is NerdWallet again. April 4th, they updated the car loan interest rates. So if you're going out to get a car, it may not be the best thing at the moment. They're still quite high. Based on what level of credit you have, you can see the average new car rates, the average used car rates. Anywhere from 5 to 14 on new and 7 to 21 on used. Now these may seem really low, but you have to have great credit. Now let's look at really the average, because they come down here and they talk about, it was just in March of this year, Edmunds said the interest rate for February was around 7% for a new car and around 11% for a used. That's about more like the average. And then there was another company, Cox Automotive. They said the average rate was around 9 or 10 for new and around 15 for used. So as you can see, the car loan rates are quite high. If you look at websites regarding the car prices, you'll see that they're quite high as well. So you may not want to buy a high-priced car at a high interest rate. Now, if you have to get a car, you do what you have to do, obviously, and there are ways to certainly achieve or purchase cheaper cars that are used or that sort of thing. But as you can see, that's what is going on in the interest rates regarding credit cards, personal loans, car loans. Obviously, mortgage rates are up. The government essentially caused inflation. The government brings in this much in tax money, in other words, revenue. Think of it as the income from your paycheck. And then they decided to spend the amount of money that came in. No, they didn't. They said, let's spend a lot more than came in. Well, we all know what that means. For us, it means debt. For the government, it means debt. But what does the government do? Well, they decide to essentially borrow the money from us. They print more money, issue treasury bills, bonds, whatever. And that causes inflation. So the government causes inflation. The Fed comes in and says, well, we're going to have to raise rates so we can try to get inflation down. And then the banks say, oh, well, if rates are going up for us, then rates are going to go up for you, the consumer. Your credit card rates are going up, your personal loan rates are going up, your car loan rates are going up, everything. So the government messes up, and by trying to fix it, they push all of it onto us, me, you, and everyone else. We have to pay it through higher rates. Fine. Now we know how the game's played and what's going to happen. So what can we do about it? Well, we need to get out of debt. I'm going to put up here this show. I put together a quick, succinct show that goes over 7 different ways of getting out of debt. We've got here the snowball method, the avalanche method, debt consolidation, budget and expense reduction. You probably heard of velocity credit card, cashback cascade. That's one I came up with. I had to get out of a mountain of debt after my divorce. That's what I used, and I mixed it with other methods as well. And then, of course, I've got one talking about how you can move from a high-rate credit card loan down to pushing it onto a car loan, believe it or not. Anyway, those are really quick in this video. And then depending upon which one you think might work for you, you can go into detail looking at some of the other videos under there as well. I do these get out of debt shows Monday, Wednesday, Friday. I may start doing it every day. And on Fridays in particular, I talk about commodities and ways of saving your money instead of dollars. Because of inflation, your dollar's worth less. So we talk about a basket of goods, whether it be crypto or gold or silver. And every Friday we track how it's been doing. I've been doing this for a while, saying, hey, you don't have to keep your savings in dollars. There have been some very impressive, smart people who have said they don't keep it. Look at MicroStrategy. They happen to choose Bitcoin. Other companies may choose gold. Central banks throughout the world are buying more gold. What does it mean? It means that there's alternatives to savings. Now, I'm not a financial advisor. None of this is financial advice. So that's it for today. I do appreciate you watching, and I hope you'll continue to watch and subscribe. Have a great day.